So in this video, I would like to talk about the following topic: how not to give away your deposit, how not to take many losses during volatile moves. I would like to discuss yesterday. Today is January 30th. Yesterday was January 29th. It was a news day, and the NASDAQ index futures lost almost 3%. You can see such a large, sweeping short move. Let's look at how it happened. What trades could potentially have been made, and what should not have been done on such days, in order to do some work on mistakes and talk about the mechanics of price movement on days like this. So, let's start analyzing. We launched the simulator on the SBProX platform. Let's pause and get to the start of trading. The US session starts at 8:30. So, the market opens. On the left, we have a 30-minute chart. On the right, a 1-minute chart. Since NASDAQ futures are a volatile instrument, the 1-minute chart is quite reasonable to watch. After the first few minutes, we see this kind of move. Several candles at once, a move to the short side. We see this kind of 30-minute candle. One could have gone to some news resources and seen that some news was coming out. If you are a beginner trader, then your only correct decision is not to trade at all on such a day, because with a high probability, you will try to reverse the market. This is risky and will end quite badly. On days like this, when we have strong macro news, there is a huge inert mass of people who will be reallocating their portfolios depending on what is said. Therefore, if a move has started, it will likely be quite prolonged, and there is no point in trying to reverse the market. If you are a more experienced trader, you can try to enter short with reasonable risk in clear situations, using a clear model that you trade. So, what should you pay attention to? The first thing you can put on the chart is support and resistance levels. Let's mark certain levels and watch how the price behaves in these areas. We mark zones, we mark horizontal levels in order to see where the actual lows are, because when lows are broken, the movement will accelerate, since sell stop orders will be activated. People place stop losses behind these levels, and therefore the movement will accelerate. Also, potentially, support and resistance levels, in this case support, can be volume levels, weekly, monthly, contract levels. These are worth paying attention to, as well as volume profile levels, such as the point of control of previous days and the boundaries of value areas of those days. You need to be attentive and watch how the price reacts when approaching these levels. We'll come back to this a bit later. So we have decided what we will potentially do. We watch how the situation develops. I also want to point out that on the right, on the 1-minute chart, we have the volume profile for the current day displayed. We will watch how the value area is formed and how the point of control moves. The value area shows 70% of the total volume that has been traded, which represents the current fair price. Therefore, buying below the value area and below the level of maximum volume is a very bad idea. This is because the price will get stuck in these zones, since people who made trades there will potentially close or reopen their positions, close their losses if they entered long, and open short positions to continue the downward move. So if we are talking about catching some kind of reversal, our task is to wait until the volume shifts downward and a certain setup is formed, either based on volume indicators or on some candlestick patterns. Only then can we talk about a potential long. But in general, initially we are looking for short positions. So the first situation where it was potentially possible to enter a short was here. We had a move, a certain amount of trading activity formed. There was some redistribution of positions and additional position building. The level of maximum volume moved into this area. We moved below this area, and potentially here, it was possible to enter a short in continuation of the downward move, on the breakout of the nearest lows. Let's open a trade in the simulator just to see how our trade could potentially have worked out. We press sell market, set our take profit and stop loss in order to see how it all plays out. There's no point in writing that anyone can trade on historical data. We are not trading right now. We are doing some work on mistakes and analyzing what should and should not be done on such volatile news days. Let's remove the levels that have already played out and watch how the situation develops further. So we see this kind of circle. This is the clouds indicator. It shows a certain activity of market buyers and sellers, which indicates trade aggression. In this case, we had aggressive selling, and this serves as a kind of indicator to confirm our trading ideas. Potentially, our trade worked out. We removed the levels that did not play out and watch further price movement.
In order for us to see a potential reversal, we need the price to come into some higher time frame levels, some specific areas of interest, and form a certain setup, either a candlestick one or preferably with volume confirmation.
So, according to classical Dow theory, for a potential long setup to form, lows must stop being updated, higher lows must start to form, and we must break the last short swing, meaning the last high that led to the move in this area. With the formation of some consolidation, we could potentially enter a long. This is how a bounce would form. So, for a long position, these conditions must be met. At the same time, we must come into a higher time frame zone. Without a higher time frame zone, it makes no sense at all to talk about long positions. In this case, we are trading near this low and observing how the situation develops. We see that this high is not being broken. On the contrary, we break this low and, in fact, while being below a higher time frame level, a potentially valid short setup is forming right now. A consolidation has formed, we break it to the downside, consolidate below the level, and let's try entering a short at market, setting some conditional take profit and stop loss levels, and watch how the situation develops. We see again that we are trading below the maximum volume level of the day, below the value area of the day. So there is absolutely no point in talking about any longs. Of course, a huge number of inexperienced traders will try to reverse the price, and on such days, the entire inert mass of sellers will simply run them over. Our potential trade works out. Let's plot a composite profile over several days. It also has a value area high, value area low, a maximum volume level, and the fair value of the asset for this upward move was formed in this area, within the value area. Therefore, when we come back into this area again, the price can potentially get stuck here. Talking about continuing shorts when approaching this area is already a rather bad idea, because in this area, the players who were buying here may resume their buying. Therefore, in fact, shorts end here if we are talking about sensible trading and trading using volumes, volume profile, and auction market theory. We mark these levels and observe how the situation develops. We observe the first reaction to the upside, but again, it was too early to talk about any longs. In this case, we see that volume continues to move downward and we observe price action. Again, we see that the low is broken and the short continuation takes place. We are below the maximum volume level, but selling in this area is not a very good idea because, as we said earlier, buying may resume here from players who are trading this zone with a longer-term perspective. Again, we are not updating these highs, we are moving lower. We come into the point of control area, but nevertheless, there is still no talk about buying. So, we see that at this moment, the price has come into a certain zone, the volume area low of this 3-day profile. If we adjust it slightly, change it a bit, we are still close to this area. These prices are potentially cheap for people who were buying throughout this upward move, so buying may resume here. And if we are talking about some kind of reversal, then potentially this zone may act as a reversal zone. Now we need to wait for our setup or for some kind of volume confirmation. So, we see that the price breaks one high, and we need it to break this high here. We see that there were some purchases here, but these are fairly small volumes to talk about any serious inflow of money. We break higher, meaning it is preferable to wait for another retest of this area in order to enter a long. These are large trades, that is, large purchases, and this is how they are displayed for us. And at this moment, we have essentially formed a situation that is quite reasonable to try entering a long. That is, we had a move, we broke this high, and a consolidation is forming. And on the breakout of this consolidation, we can try to enter a long. Thus, we see that a structure break is occurring, a trend change. We have a higher time frame level. We have the volume area low of this upward move. So in this case, it is already acceptable to talk about a reversal. Plus, there is also a certain timing factor. In this case, it is 10:30, meaning the first 2 hours of trading have passed, the active phase is over, and we can talk about a reversal. Let's watch how the situation develops. Breakout. And let's open a trade in the simulator. So, We also see that we have a certain high volume node area, a zone of increased volume, the maximum volume level, which may act as resistance for price movement. That is, potentially this area is a resistance zone, and when the price approaches these levels, it is necessary either to close the position or move it to break even. But one way or another, the price may move lower again from these levels. Let's watch how the situation develops. We saw some large purchases here. That is, in this case, a large buy. 110 contracts in a single print. At this point, when such a situation forms, we see that 110 contracts were thrown into the market very quickly in single lots, a kind of climax. Therefore, the position should either be closed or the stop should be moved to break even. Also, we have approached the high volume node area. We see that the point of control has now shifted slightly lower, which is good for a long position. But one way or another, we are in a high volume area, so price may potentially start to slow down here. Our potential trade works out, and in fact, so far this was the only more or less safe and reasonable reversal trade. Logically justified from the perspective of volume and from the point of view of Dow theory. That is, this was the only adequate situation where it made sense to talk about longs. After that, price trades around the point of control level. There may be some further movement, but the timing is already such that it is difficult to talk about opening new positions. Thus, the goal of this video was to show you that during such volatile moves, it may feel like there are many opportunities to make money, many opportunities to enter shorts. But you can see that there were only 2 reasonable short setups. Well, possibly one more on this retest here. But in any case, there were 2 adequate short trades. And on the long side, there was also only 1 reasonably low-risk trade. Therefore, we wanted to say, keep a cool head during such news-driven moves. On such news days, follow your trading plan. Do not overtrade, and use volume to confirm your trading decisions, to see areas where a large amount of volume, a large amount of money, is concentrated. We hope this will help you in your future trading.